So here in the Cash Flow Academy, the idea is to give examples of cash flow, and so we finally have a foundation built where we can do a little bit of cash flow with options. We're going to talk about selling puts, or what's called a short put, and it can be confusing: bullish, bearish, short, long, up, down. And as you just allow yourself the time to be immersed in this stuff and attend your mentor clubs and go through this stuff, you'll pick it up. We all do. I did. Not the brightest guy, but you'll get it. And you'll notice I've got a dotted line here and a solid line here, and we're going to introduce something that in this version of the 4 pillars called a risk graph. And even though we're not to the 4th pillar of risk management yet, I don't feel good about starting even slightly to give examples of investing before we learn how to manage the risk. It's so important to manage risk. We shouldn't be afraid of it, but we should certainly be aware of it. I've seen too many people blow up their account getting excited about the money rather than being great with the risk. So one of the words we use for this is called a naked put. So a naked put is when we're the ones making the promise. We're the landlord. Think about it. If you're going to be in the real estate business, would you want to be the landlord or the tenant? If you want to be in the insurance business, do you want to be the customer or the sales? Do you want to be Geico or the customer? Well, in the case of real estate, you're both. You're the landlord in one end, but you're buying home insurance on the other. So we're always going to be buying things and selling things, but the person who makes the promise usually gets the money. Let me say that again. The person who makes the promise usually gets the money. If LeBron James says, hey, I promise I'll go play on your basketball team, they're going to pay him for that. If a guy says, hey, I promise I'll let you stay in my house, he's going to get paid for that. If a guy says, hey, if you wreck your car, I promise to fix it, he's going to get paid for that. And so they call these selling puts or naked puts. Now, I'm going to talk a little bit about naked puts versus cash covered. The trade is the same, except for I'm going to lean towards this. I'm going to teach as naked, but I like cash covered. And basically what it means this is, if I make a promise, the question is simply this: how am I going to keep the promises I make? And if I have 100% of the cash on hand required, right there, 100% of the cash on hand ready to keep my promise, I go from being naked to being covered. Okay, I go from being naked to being covered. If I only have some or none of the cash I need, or the resources I need, some or none, I'm exposed and I'm naked. And people can do them both ways. You're allowed to do it both. But I'm going to talk about this in a manner of cash covered. Now, on the aggressiveness meter, we're going to put this over here in the red towards more aggressive. And I will tell you without apology that the things that I tend to do in the stock market are not for the weak, not for those who are worried, about losing once in a while. They're aggressive strategies. In fact, almost any time you use the word option, you're aggressive. Now, with that said, I think that trading stock is aggressive, right? I think many things are aggressive. So, you might have a broker that says, oh, cash covered put, it's not aggressive, you can do them in your IRA. You can do a cash covered put in your IRA. I do them in my IRA all the time. So in their eyes, they don't let you do naked things at all. But if you have the money to cover the promises you make in an IRA, there's many brokers that let you do that. So the reason this is considered higher risk is because if you're naked, you're selling a put option without anything to protect it, without everything you need to do this. So in this case, we're going to do cash covered, cash covered puts, but the trade is the same. Now, you can have a couple different objectives when you do this strategy. First, if you think the stock is going up and it's just going to take off, you might just want to collect the premium to generate some income. You might say, well, I don't know if it's going to take off huge, and I don't know that I want to buy the stock, but I'd like to get some income. the way I use these most of the time is I very much love getting paid to buy stock. I really like to get paid to buy stock. And the person I would point you to watch who has done this is Warren Buffett. He will make promises to buy things cheap. Why? Well, he likes to buy things cheap. So I asked for your patience earlier in this pillar in looking at Kraft Heinz, and we said, okay, well, here's a stock that has had some troubles. They've got a lot of debt for the price of $70-$80 a share, and they had some SEC issues, and so they had a big gap down from like 70, and now they're down trading the 20s and 30s. And so we gave an example of saying, well, you know what? Do we think this new CEO can solve some of their problems? Do we think this SEC stuff is permanent? Do we think that we can pay down this debt because they still have good income and they're still paying a good brand, they have a good brand, they're still paying a good dividend? Maybe this is one we want to own. So we said, look, rather than just buying it, let's get paid to buy it. And so now, earlier I said, hey, don't worry where that money came from. Just know that it got there. Well, now we get to come back and say, okay, how did this happen? What is this? So now we're going to look at this right here, and we're going to see some things. KHC is the name of the company, right? Look at this. We just got finished talking about what? Expiration, right? We got finished talking about strike prices, and we talked about puts and calls, and we talked about premium. So now that we understand expiration, strike prices, puts and calls, and premium, we can start to understand this a little better. And so what we did is we said, look, we're going to make a promise to someone that we're going to buy this stock at $32.50. Now notice here, it's at about $33 even here. It's about $33. And we said, look, we'd like to collect a premium, and the premium that we can collect on this is $1.22. So let's draw this transaction now in a way that's more clear than we were able to do it at the outset. So here we go. I'm the seller, so watch this. We're going to make a promise. This guy makes let's write that again so it's nice and neat. Take our time to do it, a promise. Now, I love this idea because it has to do with creativity. Think about that for a minute. Make a promise. What does it mean to make something? It means to manufacture or create. So, if you sell lemonade for a living, you got to make lemonade and then you sell it for money. If you're a car manufacturer, that means you make cars and sell it for cash. Imagine this, you're making a promise. And the only thing you need to make a promise is to have the ability to keep it. Isn't that cool? So you can get into the manufacturing business here without any raw materials, so to speak, without any manufacturing, shipping, assembly, raw materials. Really, all you need is the ability to keep a promise. And if you can keep a promise, that means you're allowed to make a promise. And people get paid for making promises. So what are we going to make a promise? We're going to make a promise or manufacture this promise to buy, right? We'll just say 100 shares. We're going to do one contract, 100 shares. Okay, I do more than this in my own account just in the name of disclosure because I can keep bigger promises, and I've done this before, so I feel more confident in doing it. I'm not perfect at every time, neither will you be. Buffett isn't perfect every time. But we're going to make this promise to buy, in this case, 100 shares of KHC. So let's just put that in a different color, KHC. And we're going to do this at a strike price at $32.50 is our strike, $32.50. And we'll look at an option chain and do another one of these all the way through. In fact, we're going to do a couple of examples here so you can rewind and review, repeat. So $32.50, And we're going to do this anytime before the 18th of April. So the expiration date right here, we'll just say expiration is going to be 18 April right there. And the premium that we're going to collect, right? The premium we're going to collect is, let's put this in blue as well, is going to be $1.22. So let's go out of theater mode for a minute with this. I think we can get away with that. Let's go out of theater mode for a minute. And maybe make this a little bigger so it looks nice. And let's just see how much that is. So notice that if I make a promise to buy this at $32.50, I should have $32.50 in there. Okay, now remember, this is on 100 shares. So if I'm going to do it 100 shares, I'd have to have $3,200 to do this. So let's look at the percent return on investment with this. Is I got $32 to cover this promise, $32.50, right, to do that. So I'm going to bring in $1.22, and I'm going to divide that by $32.50. Whoop, I got to put a decimal in there. It's not going to work out right. Divided by $32.50. Now, that's going to give me about 3% right there. Think about that. Let's do that again. Make sure we got that right. $1.22 divided by $32.50. And remember, 10% would be about $3, right? About $3.25. So yeah, it makes sense that this is almost 4%. If I times that by 12 months, because this is just in the month of April, you know, that's an incredible return on investment. Absolutely incredible return. Well, we don't get big return without, you know, some risk to this. So we're going to talk about the risk. Now, think about this for a moment. Let's talk about our risk. And I know we're not in the risk management pillar yet. We'll have more work to do there. But they're married together. You just can't get rid of risk when you talk about income and investing. So look, my promise is to spend $32.50. Now think about this. The stock's at 33 already. So here's the question. How much do I risk if I buy the stock at $33? Well, if Kraft Heinz goes bankrupt, I'd lose $33. Well, how much do I risk if I promise to buy at $32.50? Well, if I have to keep that promise, I buy at $32.50. Now, and the stock goes bankrupt, I lose $32.50. So if Kate, she goes bankrupt, my risk is about the same as if I buy the stock. The only difference is if I buy the stock today, it's at 33. If I do it this way, I get 50 cents off. Plus, I already got $1.22 in my pocket. So that's probably like a break even of $31.28. So the most I can lose is $31.28, and that's if KHC goes bankrupt. So make that comparison in your mind for a minute. Think, gee whiz, you know, if I bought the stock, I can lose 33 bucks. If I do it this way, I lose $31.28 if the worst case scenario happens, which is they go bankrupt. So my downside is just a little bit better than if I bought the stock itself. So why would you consider this more aggressive? Well, my upside is going to be capped, as we see for a minute. We're going to see that my upside could be capped unless I wind up owning the stock. So we'll show you how this works. So I have to times this all by 100, which means I'm going to bring in $122, and I'm going to have $3,250 in my account to do it covered. If you had that, they'd probably let you do that in an IRA. You can now say, look, I'm making a promise that I can keep, and it's no different than if you went and said, I want to buy 100 shares of this stock in terms of the amount of capital you would need to do this. So what's this guy saying on this side? Well, you're selling a put option. So let's put the word option in here, which means that since you're selling him this contract, right, he's going to send you some cash, which represents $1.22, and you're going to send him this agreement, right? Agreement, or this contract, or your promise, right? You're selling him this promise. So what does he get? He gets the choice to sell this to you. So he gets the choice to sell 100 shares of KHC, right, at the agreed strike price. You shook hands on it, $32.50. Now, we don't really care if he owns the stock already and is scared that it's going to go down and just wants to, get his exit strategy in stone. That's one really cool risk management strategy. He might be looking at this as on his end as what he calls a protective put. It might be protecting his stock. That way, if KHC goes to 33, 34, 35, 36, 37, 38, 39, 40, he's fine, right? He doesn't have to sell it to you. It's his choice, right? And this is going to be done at an expiration, same thing, 18th of April in this case. And he's going to pay you that $1.22. So he loses $1.22 and you get that $1.22. You make the promise, he gets to have the choice now. And that's really the transaction. This all happens electronically. Think of it more like a bank. You could draw a picture of you and your employer like this. And chances are you don't get a paycheck. Chances are you have a direct deposit. And so, there's no physical paper moving anymore. It's all electronic money. And that's fine. Nothing wrong with that. That's how the world works now. So that's a good thing. Notice that you've taken an asset of $32.50 and you've generated $1.22. That's an amazing idea right there. I get so irritated with the people that blow this out of proportion. Free money, money without any work. I think that phrase, getting money without doing any work, bothers me more than any other. I had a group come to me one time and they wanted me to support them in this monthly periodical or newsletter or something. And I looked at their marketing and said, look, you get to make this money without doing any work. Well, I guess technically that's true if you define work as working at a job, right? I was able to collect this $1.22 without having a job. And I was able to collect this $1.22 by having $32.50. So my ability to make the promise was a big deal. Since I had the ability to keep the promise, I was able to make the promise. And I can see where you can construe that as not doing any work. However, do I need to know what a strike price is? Do I need to actually go make the transaction? Could you call that work, moving a force through a distance in a time? Do I have to have an online brokerage account? Yes. Do I have to click these buttons? Yes. Do I have to monitor this? Yes. So to have money work for you, there's still work being done, isn't there? There's still work being done. And so I don't like to act like this is magic. Because you could construe it that way. Look, I just pulled a $1.22 or, in this case, $122 right out of my hat. Well, yes and no. I had to have $32.50, but that's a good return, right? That's a fair return. And this is not an anomaly. I mean, this is KHC. This is, Kraft Heinz. This is macaroni and cheese. This is ketchup. They have all kinds of brands that are associated with that. Stuff that are household names. So yeah, it's not earth-shattering that you could get this return this way. And is this aggressive and conservative? Well, I think it's aggressive because you're making a promise, and certainly the stock could go down, as you can see in the chart. It did, but you'll notice what that does to the cost basis is if we go back one, maybe I can pull this off without making it look too terribly messy. If you look at the cost basis now, as the stock's up here at 33, where the last tick is, or wherever I decided to do this was probably around here somewhere. The stock's here at 33ish, and we said, well, we'll buy it, kind of at the money, a 32.50 way. Well, now, my cost basis really is if I bought it at 31.28. So it's a way to buy these cheaper, as you collect this premium in doing it this way. So hopefully it's making more sense. Now, what we're going to do is, this should be fun. This is called a risk graph. Now, there's software that does this for us. And I hate math, and I'll tell you, I love using calculators, as you can tell, rather than doing stuff and carrying the one on a piece of paper and doing it in my head. And we're certainly going to use software to do the risk graphs. But I'll tell you, I had a great mentor. His name was Rob. And one day I said, what could I do for you? To have you teach me. And he took me over to his house and he's showing me some of this stuff. And I was very, very new as a trader. And, I wanted to pay him and he wouldn't take any money because he was a friend. So I got him a certificate to go buy a big screen TV or something like that. It meant that much to me. And it was amazing that when he was doing risk graphs, he didn't use the computer. He just sat down, got some scratch paper and started, banging out these risk graphs. I was like, wow, this guy's a genius. And he says, Andy, if you just stick with this long enough, you'll be able to do the same thing too. And I said, not me. I'm not very smart. Well, guess what? I'm getting better at it all the time. So here we go. Let's start with stock. Let's say the stock was at $33 just for the sake of argument. So I'd come here to 33 and I'd say that's where I'm going to buy it. Now notice here's my profit and loss. So if the stock were to go to 34 and I had 100 shares, let's say, then that means I'd make $100, right? If the stock went to 35, I'd make another $100. So there is my upside on the reward side of the risk graph. Now if I were to buy the stock at 33 and it were to fall to 32, I'd be here. And if it were to fall to 31, I'd lose 200. And if it would fall to 30 and 29 and so forth. And so you can see that I have this straight line on a risk graph. So that one's pretty easy to draw, right? That's for the stock, right? In fact, we should probably draw that in blue and use the green to match our options. So we buy at 33. If it goes to 34, we make 100. If it goes to 35, we make another 100. If it falls to 32 or 31 or 30 or 29, and sure enough, we have this awesome, risk graph that looks well, something like that. And so that's our risk graph. So you see again how easy that is. Start at 33, 34 is 100, 35 is 100. This would be halfway. And then all the way down here, 32, we lose $100, 31 we lose, and all the way down to there. And sure enough, we get this straight line like that. And so that would be, if we had the stock at $33. Now, what would be our max risk on the stock? Well, if we had 100 shares, our max loss would be $3,300, right? And I said always have a target. Well, our max profit would be infinity. Maybe our target is 200. We think it might go up a couple $100, and our break even is at $33. That's where we bought it. And maybe we say, the most we'd let this go down to is 31. So maybe we have a $200 stop loss on it, and there we go. And we that's how we trade the stock. We have an entry, we have a target, we have an exit. Whatever it is you want to do. Your target should probably be bigger than your loss. As I said, maybe we expect it to go to, maybe we expect a $400 profit. It goes clear up here to 36 over time, and we're willing to risk 2 to get 4. Maybe it's something like that. So every single stock that we buy, we should have a risk graph in mind. We should be able to see the correlation between if the stock goes up in price, how much money we make, and if the stock goes down in price, how much money we lose. And that we should be able to do that on paper. Now, with options, this gets a little more difficult to do. So we're going to switch to a green pen, and we're going to try and get these ideas as well. So let's look here at 3250. So we know that we've made a promise to buy this at 3250, okay? And so let's just go up here to 3250 and make a little hash mark right here at 3250, knowing that's where we start. And we know that we got paid $1.22 to buy at 3250. So if the stock's at 3250, that means we buy at 3250, which would be here. But watch this, we're going to make $122, which is about right there in profit, because we got paid the what? The premium. It's not just about the stock. We got paid to buy this. So, the very fact that it's above this black line means we've got a bit of a head start, don't we? But here's the thing. If it goes to 33, do you think this guy's going to sell the stock to us? No. So we're just going to be stuck with our 32.50. And if it goes to 34, in fact, if it goes to any of these prices right here, we're not going to be owning the stock, right? We're kind of capped out on what we can make on this at 30, if I can draw that straight, at $122. Because remember, we've made a promise, but that other guy has a choice. And if the stock is going up, he's not going to choose to sell it to us at 32.50. He says, look, I don't care if you've promised to buy at 32.50. It's at 35, pal. And so, thanks for promising to buy at 32.50, but I'm not interested. So the reason that this might be more aggressive than just buying the stock is, if you take the risk of buying the stock, you have a reward that's clear up here. So, as soon as that hits about 34.25, it would have been better to own the stock, wouldn't it? Would have been a better choice just to buy it at 33 and own the stock. But up until that point, this is a better move. This is a better way to do it. Okay, or in that sense. Okay, now what we've got to do is we've got to figure out. So our max profit goes from an infinite possibility to $122. To $122. Now understand, infinity is a long way from 122, but remember, how realistic is it to expect this stock to go to infinity? By even listing it there, it suggests that it's possible. It's actually not possible for this to go to infinity because there is no such number. And is it really even possible that would it double in a week? Well, or in a month? Well, it's possible that it could double, but it's certainly not going to hit infinity, and it's probably not going to double based on probabilities. So I have my max profit is 122. And that would be my target profit. It goes up. That's a good target profit. Remember, we had a good return at that, right? Off $32. If I can make off $3,000, if I can pull in 122 off $3,250 in a month, that's pretty good money working for me. Now let's figure out what our break-even point is and how did we come up with that. And hopefully this math isn't too wonky for everybody. But let's look at this. We know that we are going to buy the stock at $32.50. That's where we have to buy the stock, and we're getting paid $122 for that. So if we go, or $1.22 for that. So if I say, look, $32.50, okay, minus the $122 I get for doing it is $31.28. So my actual break-even point, or what we'd call my cost basis, let's get my green pen up here, is really at $31.28. That's my break even. So let's write that in, $31.28. So look, I go to $31 and, there's $31.50. I'd say $31.28 is probably about, what would you say, about right there. Is that fair to put it? If that's $31.50, $31.28 is probably about right here, I'd say. That's probably a good spot for it, right about there. Let's see if I can make a dot at $31.28. How about that right there? So I begin to draw my line like that. Notice that it's just as if I bought the stock now, right? It's just about the stock. For example, if I had it at, if I bought it, watch this. If I bought it at $32.50, right? If I bought it at $32.50 and I hit equals, and I buy it at $32.50. Let's say it goes down to $29, or even $29.50. That might be easier math. So let's subtract $29.50 from that. That's going to be a $3 loss, right? $3 loss. But guess what? I have to add to that my $1.22. Isn't that right? So look at this, $3 loss. But remember, I'm not going to lose $3 because I made, I have $3 I've lost. But remember, I made $1.22. So I'm not going to lose the whole $3. I'm going to make $1.22. So my actual is $1.78 or $178. So right here, let's get my green pen up, is I'd go to about what? Oh, that's not quite $200. Let's say 178 is about there. You'll notice that's right in line. Look at that. Just bam. with my risk graph. So I'm going to lose money in this trade at the exact same rate that I'm losing money in the stock. But watch this. I'm going to put this in blue. Watch this. This is my break-even point if I buy the stock at 33. Look at how that lowers it. Now this stock can fall clear to $31.28 before I have a break-even point. That's quite a drastic difference in where I break even at. So I'm still doing better with the option up to this point and than I am with the stock, and I'm doing way better with the option all the way through, and you can take this all the way down to zero. So maybe my target loss here now is maybe I say, look, if this hits $30, maybe I'm not interested. Now for me, I would be interested because I don't mind buying this stock at 32.50 when it's down to 30. Why? Well, I was willing to buy it at 33 and have it go down, right? I'm looking at this Kraft Heinz, and I'm going to show you how I manage the risk if it really dies, but I'm expecting some ups and downs in this, right? I'm not dumb. I expect this to be fluctuating. So I'm just asking a bigger picture question is, are we still going to have ketchup on the table in 20 years from now, right? That's my thought on this. So I'm going to use my fundamentals and my technicals, but maybe if I wasn't looking to do the stock, maybe I say, you know what, I only want to lose $100 on this, so if it falls all the way down to maybe 30.50, maybe or 30.25, maybe I say I only want $100 loss on it, so I put that in, maybe something like that. Now I don't care what you put in. My max loss, of course, is going to be 32.50 minus the $1.22 I brought in. So my max loss on this one is going to be $3,128. And not that you would need to understand these numbers the first time you go through it, okay, the first time you go through it. And to do a risk graph like that, it takes a while to learn how to do them, especially by hand like this. But it is an interesting way to look at the amount of money you make if it goes up, and the amount of money you lose if it goes down. So you can see obviously you're losing at the same rate, but you're about $122 ahead doing this way. But if it goes up, once it goes up past here, it would have definitely, you can see it's better to own the stock than this option. But notice that where it is right now, if it goes up a little, you make money. If it stays the same, you make money. If it goes down a little, you make money. It has to go down below here before you start losing, whereas here, boy, you're losing right out of the gate. So this is what the graph would look like at expiration. This is your promises at expiration. We're not going to include the time portion of this, just the intrinsic portion to make it simple. But that's a basic risk graph for this trade. And I think the thing I'd emphasize is it would make sense to me as an investor to understand what my max profit potential was, my target, what I think could happen. Like infinity is not realistic, right? Hey, $400 might be realistic, right? Well, if it goes up there, with the option I'm only making 122. But figuring out where I'm going to get out, if it, my target loss, and then if they went out of business tomorrow and I didn't know it, this is where it would be, right? So it just makes sense, I think, as a very minimum, to at least have this much information and to be comfortable with those scenarios and mature about those scenarios, understanding they're not magic and not just guessing. So in the Ultimate Options class, we do risk graph after risk graph after the risk graph. You get the opportunity to practice this and get really good at it with some very elaborate trades. And we don't use the computer in the Ultimate Options class because we know that our students have reported they like having the knowledge to be able to build this. And then once they know how to do it, well, then you use the computer, right? But now you're not going to look at a computer screen not knowing what this would look like, right? Not knowing what it would look like. So pretty cool stuff, actually. Pretty fun stuff. So now, if we look at this now, we say, oh, okay, well, I understand now that my break-even point is 31.28. I understand that that's my new cost basis. I don't lose money until it drops below there now. And you saw before how doing this over and over and over should drop our cost basis lower and lower and lower. Now, we took this screen capture in July, and we've had a chance to have a little time go by. And so let's look at where KHC is as of this recording. And I hate to do this because I like things that are called evergreen, that just last forever. And 5 years from now, someone will look at, well, that's 5 years old, or 10 years old, or however old it is. But you know what? The principles will remain the same, and it will be fun to see how this plays out. Especially when we get to risk management, we're going to use the same stock. So let's pull this off here, and now let's make the bridge between just doing this in theory to doing it in a paper trade account. So this is a paper trade account. The stock prices are real, and of course KHC is a real stock. And you see where it gapped down here, where it had that big problem, and we can see April where it was, and we can see it's had some dips and some rises. It's got some really nice resistance right here, resistance right here, and you'll see how that line of resistance, we got some good support in here now. We have a real good idea of where this thing has been behaving. And let's say we wanted to do this now, and just in all disclosure, I've some of the trades I show I do in my own account, some I don't. This happens to be one that I have, but I reserve the right to tell you that this is not a recommendation in any way, shape, or form to purchase Kraft Heinz. This is an example of what this would look like to give you confidence in how it would be done in the real world. So we've been writing puts and acquiring this stock at lower and lower prices, so when it pops back up, we have a lower cost basis than if we were buying it today. But right here, it's at $33. It's back here at around 33 or so, right around in there and change. And we can do an automatic risk graph on it. So check this out. This is kind of fun. So we say to ourselves, gee, maybe we want to do it at 32.50 again. Let's see what we can get for it today. So we'll add a simulated trade, and sure enough, let's get rid of this. Sure enough, we get our look at our first option chain, and we can see that we have an expiration date of December 20th. So about maybe 30-40 days away from here. We have our strike prices of 15, so these we want to have them. Notice they change color. If it's trading at 33ish, 32, 32.85, notice that these are the at the money options between 32.50 and 35, right? And then over here on the calls, these are in the money and these are out of the money, and in the puts, these are out of the money and these are in the money. So you should have already had some practice with some type of an option chain, and you should at least know the premium, which is over here in the bid ask. If we go between the two, that's called the mark. We should know the strike price, and we should know the expiration. We should at least have these three as a minimum. Now, later on, you'll want to know these Greeks, these delta, gammas, and thetas. And we'll want to know the intrinsic value that we decided we could do the math on, right? If here's the premium, then how much is intrinsic and how much is time decay, and we talked about that as well. But we'll definitely want to know these Greeks eventually if you want to get into option trading for real. Again, this is a simulated account. This is a paper account where we all do these things. And there's some nice tools to this. We have a market maker move, expects a 30-cent move on these either way. So not very much of a move is expected, but it could be more. And we say, what if I just wanted to buy these at 32.50? What if I just wanted to buy them? Well, here it doesn't look like I can get $1.22, but it looks like I could get these probably between these two, probably around 95 cents would be realistic. So what I do is I click on this. I say I just want to sell one of these, and I want to change this. I want more than that. I want to get 95 cents out of it, which would be $95 on 100 shares. Would it not? Would it not? So maybe I bring this open a little bit here, and I bring up a risk profile. And you'll notice that it looks very, very similar to the risk profile that we had before, doesn't it? Very, very similar to the risk profile we had before. It had this line coming at a point, then it began to drop at that angle. So it's very much like the one we drew. This one's just automated. And let's see if we can do it the same thing here. So Our strike price is the same. It's 32.50. So we come here to 32.50 and we go straight up. And we said, look, we made $95, which is right about almost $100, isn't it? Just shy. Just shy. You know, if you go in $5 increments all the way up here, just shy. And sure enough, down here in our box, if you look carefully, we can see a green 95 there down here in this box. It's hard to read in the way I've got the settings right now. And so notice that it levels off, because no matter how high the stock goes, if it goes to 36, someone's not going to want to sell it to us for 32, so they'll walk away and we'll just be left with our premium, which is just fine, which is absolutely just fine. Now, as it comes down, notice that I have a break-even point right here, and let's see if that makes sense. 32.50 minus 95 is going to be right around, 31.55, somewhere around in there. That sounds about right to me. And then it just goes down from there as if you own the stock. So this risk graph really, really helps. And these get elaborate. For example, I can say, let's draw this little slice right here. Let's drag this over to my break-even point, right? And see what that has to say on December 20th, okay? So it says, look, there's a 66.93%, so 2/3 chance that it will be above this area, that'll probably be above here. So chances are I won't get the chance to buy the stock above this point, and that I'll probably make money here. But there's a 1/3 chance it could be below. But this is what's really cool. Let's go down to where the risk graph is like a $200 loss, which is like right about here. So let's see what that would be. Let's go to a $200 loss about right here. Well, based on standard deviations, there's a 90% chance that I'm going to be over here. There's only about a 10% chance. And in the words of Dumb and Dumber, right, and Jim Carrey, so you're saying there's a chance. Yes, there is. And it absolutely can happen. But this is what's exciting. Is the further down I go, the least likely it is, based on how the stock has behaved in its standard deviations. Based on how far I've done, it's really smaller chances that I'm going to be paying a lot for stock that's a little. And just keep in mind that if I buy it today for 32 and change, 32.80, I have that same risk, right? I have that same risk. So the idea of using this technique as a way to, that right now, I believe it's, let's just put it where it is today. If it'll show me a tick mark, it's at 38, 32, and somewhere around in here right now. That's a really cool idea. So by learning how to do the risk graph by hand, right? By learning how to do the risk graph by hand, that's helpful. That's helpful. Then we can come in here and make them automated. Now, just for fun, let's say that I was just to do the stock and I was to pay what they're asking and buy that stock. Watch this. There's my straight line risk graph like we had before. See that? Just like we drew before. And so this is what it looks like if we do the option. Notice that it caps the gain, but let's just decide where our break-even point is. Our break-even point even here is 31.54 on this one, right around there, 31. It's actually 31.55 because we have a 95-cent option, depending on what we paid for it. And then we look at this one. Watch where our break-even point goes. It's clear up here at 32.86. So that's right, 31.54 is correct. So notice we go from a 32.84 break-even point down to a 31.54 break-even point simply by doing this option. You'll notice that at this point we're right about what, almost 50-50, if I get that right on where the stock is today, right? It's about 50-50, but down here it's about 60-30 that we make money doing it this way. So it improves our odds a little bit, gives us a chance to buy a dip, and if it goes up, great, we still get to apply that 95 cents towards our cost basis, right? Towards our discount if we decide to buy the stock. Chances are we probably sell another put. We just wait for a nice dip to where we're getting paid to buy the stock. So that's an example of what it would look like today and how much we could get. And I said you should play with the different strikes. If we wanted to go out further to January, you can see we can get a little bit more. But remember, When we're selling options, there's that time decay idea, right? Where we like them 30 days, maybe out here would be as far as someone might want to go. Here you can get $1 for it if you want to go out another, week or so. So that's exactly a week or so. If you want to go even less, you say, you know what can I get out of this in the next 5 days? If I look at what and by the way, I actually own this option. I got over $100 for it. Now I could sell it or buy it back much cheaper. See, now I'm only going to get the 32.50, maybe 30, maybe 40 cents, which, for 5 days, not too bad, right? 5 days from now, that's not too bad. Go pick that up, do the math on that. So maybe a person says, gee, I take 40 cents to buy it right there. I'm going to buy it anyway. Why not buy it right there? So that's kind of fun stuff on how the the naked stuff works. So just for review, a short put is when you make a promise to buy a stock in order to collect a premium. That's what we did. We promised to buy a stock in order to collect a premium. How does that look? Well, we come over here to the put side and we decide what price we'd like to buy it at, and we find out how much they'll pay us to make that promise. Someone's going to say, that's insane. You mean they're going to pay you to buy something you're going to buy anyway? Yep, that's exactly what I'm saying. And, you can just find Warren Buffett doing this, all over the place. In fact, if I don't know, if I were to Google this, I guess, let's see if I can find something here maybe on it. Buffett, right here, scores with derivatives. I often do this in my webinars. Let me just sign in here. This is an old article from the Wall Street Journal. I'll just sign in here to my Wall Street Journal account. And you'll see, Buffett scores with derivatives. And just notice right here, notice the language that you've used, okay? This year, Berkshire Hathaway, the Omaha, Nebraska Holding Company, has collected what? Premiums. Now, we just collected $122. He's collected a little bit more than that year, about 10, 15 years ago. And he does this all the time. You can find more recent stuff than this. From selling what? Insurance or promises in the form of derivative contracts or agreements, which what? Promise or guarantee payment to the buyer. In other words, we'll buy this stuff and we'll pay for it, but we get to buy their stuff. So all this fancy jargon is the same thing we just did. It's the same thing we just did. We collected a premium by selling a promise, right? Promise right here, that guarantees that we'll pay the buyer of this contract the money to buy their stuff cheaper than it is today. So he does this all the time, right? All the time. There's so many articles on Buffett doing this. Let's see if there's another one. This is called, see if I can bring this up from this naked investment strategy helped Warren Buffett make millions. Well, naked, he's covered. He's got enough money to do it. But, $7.6 billion from 94 different contracts that he sold. And put options is just one of the types of derivatives he deals with, one you might consider adding to your own investment arsenal. Now that kind of scares me because here they say, yeah, start selling puts. Well, what if you don't know how to do this, right? What if you haven't, you're going to read this, right? No, there's no risk graphs here. And so this is important stuff to learn and to have a mentor and to have someone you can ask questions on and stuff like this. So again, I'm not recommending KHC. It'd be fun for you to practice by saying, well, let's just look at Caterpillar, right? Or whatever. Type in anything you want. Type in Apple and just start looking at these different risk graphs you can build and different types of stuff that's out there. In the Mentor Club, it looks like we've got quite a few things on this, and so the risk graph is going to get rather elaborate, isn't it? Right? Rather elaborate risk graph. And learning how to use these risk graphs begin with a class like this, and knowing what your upside is and what your downside is. Right now we're in pretty good shape with this one. We're set up to make, it looks like over $1,000 on this one. So by learning these things, hopefully it's a great 1-2 punch that in Mentor Club, we start learning, learning how different stuff works, and you start learning how these risk graphs work. But it all starts with something very, very basic like this one, KHC. Very, very basic risk graph. Let's do this again. See if I can get a little edge to this and bring it down. And something real basic right there. It's real easy to understand. Blow it up, move it around, make it simple. There it is. Good looking graph, good looking risk graph. So there you have it. When we come back, we'll start moving on from this cash flow strategy, which is a cash flow that you get paid for buying stocks. Now we're going to move into covered calls, which lets us get paid for selling stocks. We'll be back in a bit.